Okay, good afternoon, everyone. I'm David Paul. Welcome to our VectorVest webcast, a proven approach to build wealth quickly and safely on the London stock market. So our room is full. We've got people from all over the world, and I'm also streaming this on YouTube. Those of you on Go to Webcast, welcome. Those of you that are on YouTube, great to see you. This is the third time that I've streamed this on YouTube. The first two times went okay. Those of you on YouTube can see a little picture of me, I think, and those of you that are on Go to Webcast just can't. Okay. Yeah, thanks, Derek, for that. I know how to actually. We had a little bit of gremlins yesterday on our weekly Q&A, folks. That I seem to have sorted out. Hello, Jay. How are you? Let me start. And I'm taking you, as always, those of you that are subscribers will have seen this 1,000 times, but VectorVest is pretty much the only software provider for the stock market and education provider in the UK that's authorized by the regulator, the FCA. And although I'm qualified to give financial advice, I can't do so because I haven't sat down with you and done a long and a detailed fact find. And I'm sure that's the sort of thing that you've done with your financial advisor over the years. It's a long multi-page document that they have to go through with you. Because I haven't done that, I can't give you personalized one-on-one financial advice. I'm allowed to talk about shares that I hold myself, but I have to make it very, very clear to you that although those shares are suitable for me, they may not be suitable for you. So that said, I can move on to topics hopefully more interesting. My objective, and it's a lofty objective in a couple of hours, not a couple of hours, a 1 hour, is to show you how to invest with confidence and outperform the market in a few minutes a day. Now, let me get this clear. I'm not talking about day trading here, and I've confused people with this in the past. I'm not talking about buying the London market at 9 o'clock and selling it at 10 past 9 and making a profit. Nothing could be further from the truth. I'm talking about finding and buying into a portfolio of solid investments and managing those investments in a few minutes a day. And my motto in all of this that I've been shouting out to people for the last 40 years is that don't avoid risk, ladies and gentlemen, manage it. And that's going to take us a few minutes every day. And the objective is to show you how to retire younger with more money than you ever thought you could with minimal effort. And one of the places that in fact rewards you for minimal effort is the stock market, because there's a great deal of noise, and those people who go anywhere near the noise can quite easily get beaten up. And you've only got to look at the stats from the spread betting companies to see that, where they openly advertise that 75% of people who go anywhere near it end up losing money. The noise is difficult. So what we're going to try and do is to show you how to retire younger with lots of loot by three ways. The first way is, and this may sound obvious, capital growth. We want to buy shares that are going to rise in price. That's the first way. Secondly, we want to get paid dividends, and with any luck have the discipline to put those dividends back into the mix. Now, I have a PhD in mathematics, and when I sit down with Excel and I do a little bit of compounding at about 15% a year, let's say, and then adding in 3 to 5% dividend growth into the mix, I'm always completely aghast at how fast money grows. Einstein said it was one of the wonders of the world. And the third thing, although it's very difficult in the UK, the third thing is that we can make extra income by writing covered calls. Now, Jay, who says he operates in the American market, that can be done very easily in the US market. much more difficult in the UK market. And my colleagues in the US tell me that by writing covered calls on shares that you've got, you can conservatively add in quite a bit more to the mix and maybe make over the year twice as much as the share pays on a dividend without taking any great risks to your portfolio. That is pretty much out in the UK. Even on the most liquid stocks like Shell, for example, you really struggle to write options. You might be able to buy a call and buy a put, but to actually write an option on the shares that you've got at the retail level is now near impossible. That wasn't always the case. 20 years ago when Life was operating, Life used to be where IG is at the moment in Cannon Bridge. There was a fully functioning and very liquid traded options market, but that died a death when Life was sold. London International Financial Futures Exchange, for those of you that are not old enough to remember it. So we're going to do our best in the UK to build wealth by finding shares that are going to rise in price, shares that pay a dividend, and having the discipline to, in fact, add the dividends into the mix. Okay, that's me. Unfortunately, a day or two away from 66. That photograph taken, well, it'll be 2.5 years ago now, when I paid a visit when we could still travel. That was December 19, I think. Yeah, December 19, when I made a visit to the floor of the New York Stock Exchange. Normally went there every year, but clearly haven't been traveling in a while. I have lots of really good friends who, in fact, are trading on the floor of the New York Stock Exchange, mostly South Africans that I trained while I was living in Johannesburg. So my background is checkered. I've got a degree in mechanical engineering. I've got an MSc in metallurgy. I've got a PhD in applied mathematics. And I went straight from London in 1980. I went to 1981. I went to South Africa to play rugby. I went for 6 months, stayed 35 years. And I started to trade while I was working for De Beers in Johannesburg. And I traded while working for De Beers until 88. In 1988, I made, I think, 3.5 to 4 times more my salary by jobbing on the trading short term on the Johannesburg Stock Exchange, mostly on gold stocks. And I cut the corporate umbilical cord in April 1988, and I've been trading on my own ever since. And over the last 10 years, I've been helping retail traders improve their performance, initially in South Africa, and then in the UK, and I moved back to the UK permanently about 5 years ago. So I've been back in the UK as a UK taxpayer for the last 5 years. I'm very happy here in West London. So that's me, but this seminar is all about you. So my little agenda is the VectorVest system of analyzing shares, stocks, and during the course of the presentation, folks, I say shares and stocks means the same thing to me. The second part of the presentation is quite controversial. At VectorVest, we firmly believe it's a good time to be in the market and an awful time to be in the market. And we want to define when it's a good time to be in the market. A little controversial because I know if you read the paper, if you watch Bloomberg, CNBC, they're going to tell you that that's impossible. And then I'm going to try and fuse it together into a safe and a worry-free investing strategy where we do our best to tick the boxes and to put the force of probability at our back. Nobody knows what's going to happen next on a trade-by-trade basis, but we can build a very, very strong edge in markets where when we're correct, we make an awful lot more than when we're incorrect, and we can't ask for anything more. So let's get cracking. I haven't had a comment for a while. Our room is really full, folks. It's a great honor for you all to come and listen to me. Could I just, Derek, if you could tell me that if the sound's coming through okay? I haven't had a comment for a while. just all good. Oh, Carwin, how are you? Thank you, everyone. It's just that a little bit on edge after yesterday afternoon when we had that gremlin. So the VectorVest system for analyzing stocks, and well, I always put this slide in, but I think it's really, really, really important at the moment because it's in the news. The three things that affect stock values and earnings, clearly. Buffett's mentor, a guy called Ben Graham, said that earnings per share is the engine that drives the share price. And it's reasonably intuitive. If you own a little shop and that shop makes more money next year than it does this year, then your little shop is going to be worth more next year than it does this year. It's as simple as that. Now, the other thing that affects valuations is inflation and interest rates. And clearly, inflation has been in the news over the last month and over, not last, but yeah, last weekend before last, the market seemed to wake up to inflation. And those of you that were in our Q&A session last Monday, not yesterday, last Monday, will have noted that just at the off in the American market at 2:30, it just flew down for 2 or 3 days based on inflation worries. So three very, very important words. And out of those three words, Dr. Delito, the founder of VectorVest, who would class himself as a fundamental analyst, put together a valuation algorithm that puts a value to every share on the stock market every single day. And so that we can see at a glance, or we can search for it, shares that are trading below the VectorVest valuation. And as a default, if we can, we want to be involved in shares that are trading below the VectorVest valuation. One of our members, the lady who we struggled IT-wise with yesterday, Susan, she only buys shares that are trading below the VectorVest valuation. And my word, she's had one heck of a track record. Sometimes I'm happy to buy a share that's trading above the VectorVest valuation if the next parameter is okay. And the next parameter is relative value. Now, this is the most magical number on VectorVest. It's an indicator of the long-term price appreciation potential. So it is a projection. For long-term, read 3 years. So it's an indicator of the long-term share price appreciation in relation to what a corporate bond will pay over a period of 3 years into the future. How do we do this? Well, Dr. Delito's algorithm projects the earnings of every company on the London stock market for the next 3 years. That's done by one, extrapolating from the financial statements, which we buy from Thomson Reuters, and more importantly, purchasing an earnings forecast from the world's top provider of such a company called FactSet. So we project the earnings of every company next year, the year after that, and the year after that. 3 years out. We make the following assumption. We assume that those earnings will be discounted into the price at some time within that window. No timing, just 3 years within that window. And we work out what the projected price will be. We take the projected price and we subtract the price today to get the upside. And we divide that upside by what a corporate bond will pay in the same period. So relative value, ladies and gentlemen, is looking forward. Now, it's on a scale between 0 and 2, like everything else pretty much on VectorVest. Less than 1 is not good. because this means that your share is going to give you less money than what a corporate bond will pay over that 3-year window. And those of you that understand the pecking order of who gets paid and when people get paid will know that the bondholders get paid right at the front of the queue. So you'd be taking risk and for not that much reward. Now, greater than 1 is okay, and greater than 1.25 is good. Now, one of the prerequisites, ladies and gentlemen, of our worry-free plan for us to get wealthy in this worry-free plan is capital growth. And we've found by a lot of testing, and our subscribers have found, that if you have a relative value of greater than 1.25, that adds greatly to the ability to produce long-term capital growth. So the first characteristic of a worry-free share is that it should have a relative value of greater than 1.25. It's going to outperform a corporate bond by 25%. Now, many have got much, much more than that, but that's the minimum requirement for a worry-free share if it is going to qualify for our capital growth requirements. Now, the relative value is a really magic number because it answers the age-old problem in investing. Because the normal gauge of value that is quoted by everybody is what's called the price to earnings ratio. And that's the share price divided by how much money it's going to make. And it measures the number of years that it takes for you to pay the share off. So a share that's on a PE of 20, it's going to take 20 years earnings to pay for that share. Now, the old question that many people have been scratching their heads about for a very long time, is it better to buy a share that's on a PE of 50 or a PE of 5? On first examination, it may seem obvious that a share on a PE of 5, you're getting this share for 5 years of earnings. Whereas if it's on a PE of 50, you've got to wait 50 years to get your money back. But it's not that simple. A share on a PE of 50 could be a bargain if the earnings are rising geometrically. And similarly, a share on a PE of 5 could be what's called a value trap if the earnings are falling off a cliff. So PE looks back. And this was brought home to me. I've told this story many times for the regulars. This was brought home to me by a very good friend of mine who had his own shop, his own asset management business. And this was in South Africa, in Cape Town. And he was head of investments at a major listed company, both listed in Johannesburg, listed in London. And he started off his own shop maybe about 10 years ago. And like we all do from time to time, he fell in love with one stock, an engineering company. It was on a PE of 2, and he kept buying more and more and more and more of it because he thought it was a snip. There was a very good reason it was on a PE of 2. Okay, it was going bankrupt. So Amazon's been on a PE of 80 to 100 forever. So relative value answers the question immediately. Is a share on a PE of 2 better value than a share on a PE of 80? So it really is a very unique number in the investment world, and that's why I'm spending quite a bit of time on it. And to satisfy our capital gains requirements, we found that if the share has a relative value of greater than 1.25, then that adds greatly to our ability to grow a portfolio of shares so that we can get wealthy. That's the first characteristic. The second characteristic of a worry-free share is relative safety. Now, relative safety, there is no measure of, no prediction. It looks at the past. So it looks at the last 5 or 6 years of the financial statements. So it looks at the balance sheet, the income statement, the cash flow statement. And it looks at dividends, it looks at margins, sucks them all in and spits out one number which represents the consistency and the predictability of the financial performance. Again, less than 1 is not good. This is a share where the financial performance has been up and down. Greater than 1 is fair, and greater than 1.3 is excellent. This is a company that's making money, and all those ghastly financial ratios are getting better. So for our worry-free investing technique, we want to find shares with the highest possible relative safety. And to do that, I'm going to sort all of the shares on the London stock market by the RS metric. So immediately, the characteristics of a worry-free stock, that it's got its ability to grow earnings strongly and has a track record of doing this safely. It's got a track record of, in fact, improving every single year. And these are very special animals, ladies and gentlemen. And there's not that many of them on the London stock market that have got an RV of greater than 1.25 with a relative safety of greater than 1.3. And VectorVest finds them very easily indeed. And that's the basis of our worry-free technique. I have a question here. Yes, Charles, there'll be a recording of this a little bit later. The Americans should send it out before bedtime, so you'll get it by all means. Hi, Yadi, how are you doing? Charles says he's on his way to work. Charles, we need to fix that. We need to fix that, this working. Fools and horses. I'm just joking, man. The next proprietary VectorVest number is relative timing. And this measures the direction of the short-term price trend. And if we were doing a talk on momentum trading, it's vitally important. And then what Dr. Toledo did is he put these three things together into the master indicator RV, RS, and RT. And amalgamated these three into the master indicator VST. And again, if we were looking for short-term investments, short-term trades, that's a great place to look. And that's what I did yesterday afternoon in our Q&A session. In a few minutes, we found, I think, 3 or 4 investments that look, and trades that look very good. However, today we're not doing that. And today I'm going to sort all of the shares in the London market by relative safety. And again, to use one of my famous rugby metaphors, we're going to do our best to let the ball do the work. We calculate a stop loss for every share in the market every single day. And the VectorVest stop loss is a very special animal, folks. It's based around a 13-week moving average, 65-day moving average, but it's adjusted for the fundamentals. If the fundamentals are good, RV and RS are high, and they're going to be with worry-free stocks, we widen the stop loss. So for shares that have got great fundamentals, we give them more room. And the VectorVest stop loss is doing weaving a very fine line between allowing the position to run and protecting your capital. And those of you that have been in markets for a while will know that that's a very, very fine line. Stop loss too tight, you get stopped out invariably before the big moves. The market will go down, run the obvious stops before it goes. I assure you that happens over and over again. And if it's too far away, then if the market pulls back, you give up too much money. So the stop price does its best. It's not easy. Stop losses are difficult. But it does its best to put the stop loss in a place that won't easily be hit, but still protect your capital. And we put a buy, sell, or hold to every share in the market every single day. The buy is largely a trend following signal with very little fundamentals in there. The only fundamental is that the VST must be greater than 1. Now, clearly, we've got buy, sell, or hold. The sell is obvious. If it drops and closes below the stop price, it's on a sell. Now, for our worry-free technique, folks, I want to buy shares that are either on a buy or a hold. If they're below their stop loss, no. So in essence, I want to find a share with a relative value of greater than 1.25. It should have a high RS, hopefully above 1.3. It should either be on a buy or a hold. And it should have enough liquidity so that we can get in and out of our position easily. Now, that liquidity is going to be a function of how big your account is. So if you are Warren Buffett, there's going to be an awful lot of shares that you can't go anywhere near because of the size of your position. If you're starting with a small account, then you can pretty much buy into anything. And a golden rule that I was taught when I started this way back in the 1980s is that the share should have a daily volume of about 20 times your position size. So if you're going to buy £10,000 worth of shares, you would want £200,000 worth of shares traded every day. Whether that's right or wrong, I don't know, but that's what I was taught so many years ago, and it seems to work okay for me. So I now want to look at the program itself. I've gone on a little bit long on RV, so I'm running over a little bit, but that's the VectorVest program. And I'm going to spend some time on the front page in a few minutes. But if I go to viewers now, it takes me into the stock viewer. And that's yesterday's date. And we have got 2,060 companies that we're following on the LSE and on AIM. So if I have a look at a share that we've done really well in, certainly the people that follow the Q&As on Monday afternoon, this is Sylvania Platinum. It's a share that I know well. And those of you that know me will know that I have a farm in Africa. I love saying that. Somewhere between Johannesburg and Pretoria, in the middle of nowhere. And I have a horse on the farm, and if I actually saddled him up, I could in fact ride to Sylvania Platinum relatively easily. I have to cross the Crocodile River on the way, and he's not particularly keen on that because we were charged by an ostrich there once upon a time. But if we could get over the Crocodile River, we could get there relatively easily. It's trading at 138. VectorVest believes it's worth 277. So it's trading at pretty much half of what we think it's trading at, should be at. Yes, Louise, he got scared stiff for that ostrich. Ostrich comes straight at us. And I was up around his ears by the time I got him pulled up. So I just bolted. So RV. is an incredibly important number. If you're a momentum trader, an incredibly important number. If you are a worry-free trader, an incredibly important number. It tells you immediately about the future. Now, PE tells you about the past, but RV tells you about the future. And in this case, we see that the share's on a PE of 6. If you see a share on a PE of 6, in other words, 6 times earnings, so it's going to take 6 years to get your money back. But you don't know, is this share on a low PE because the darn thing is falling apart, earnings are falling apart, or is it cheap? Until you look at RV, and when you see a 1.84 RV and a PE of 60, it's cheap, I assure you. If you saw a PE of 6 and an RV of 0.7, then it means that earnings are falling apart and it's a value trap. Now that question has been thrown around by university professors in economics when it was started to be chucked around. I had hair a long time ago. This an incredibly important number, RV. I can't say that often enough. It answers that question. RV at 1.84, RS is 1.32. That's up where we wanted to be. VST is 1.47. It's on a buy recommendation, so it's going up or going sideways. I didn't have time. There's a stop loss, 123. That stop loss can be, if you buy into it, that can be used as the initial stop. And as your share moves up, that can be used as a trailing stop loss to keep you in the position. And I didn't get time to actually speak about CI is a measure of the long-term trend. And at 1.86 on a scale between 0 and 2, it's saying the long-term trend is tremendous. The growth rate, projected annualized growth rate, looking forward is 42%. That's quite a clip. And but the really definitive thing is the PE is 6. That means it's cheap. And looking forward, the potential is awesome. And that is an enormous edge in markets. So that is the VectorVest metrics. Now, in a second, we have a lady at VectorVest. She's the lady that suffered. She struggled. I didn't hear her yesterday because I had gremlins on my PC yesterday. Everybody else did, but she doesn't look at anything more than the front page of VectorVest to find the stocks that she invests in. She just eyeballs. Now, some people like that. Some people don't like that. But in a second, we're going to go to UniSearch, and UniSearch will do all this searching for us automatically. But before we do that, we have to go to something that's quite controversial. And that's market timing and market direction. Because I assure you that pretty much everybody's out there is going to tell you that it's not timing the market that's important, it's time in the market. And of course, time in the market is wonderful if you've got 30 or 40 years ahead of you. I wish I had. And our mantra is buying rising stocks and rising markets. And for another day, selling falling stocks and falling markets. If I was doing a seminar on short selling, which is a very aggressive trading strategy. So we're not going to cover that today. It looks expensive, Gary. That's all I got to say. It looks expensive. Nothing more to say than that. Gary's talking about impacts. It's running for the moment, but it looks expensive. If the market turns, it could get a haircut, or if they don't do what they say they're going to do, it could get a haircut. Well, fine for a momentum trade, Gary, but for a long-term hands-off trade, I've avoided it for that reason. For short-term momentum trading where you're managing risk proactively with stop-loss orders, it's been outstanding. But for a hands-off, worry-free investment where you want the ball to do the work, I've avoided it for that reason. Does that make sense? It's on a buy recommendation, Gary, because it's rising. Okay, it's on a buy recommendation because it's rising. I think that you still got to look at the share in relation to your objectives. If you were a short-term trader, a momentum trader, then it's fine to look at that. In relation to this particular technique that I'm presenting, the fundamentals are not there. Does that make sense? That is a very often asked question, okay? So you still got to dig a little bit deeper than the buy recommendation. So this is a quote by Dr. DeLito: buying on the wrong side of the market is the worst thing that can happen to an investor. It doesn't have to happen to you. This was brought home to me by a story my father told me. He told me that in 1969, I was 14, in 1969, the London market made a high. And he said then it took 21 years for the market, in fact, to break that high in real money. So what happened in 69, the market made a high and it went down until 1981. And it bottomed out in 81. In 81 to 90, it took 9 years for the market to get back up over the 1969 high in real money. 21 years. Now, if you look at the London market, the overall London market now, it's not that much higher than it was on the 1st of January 2000. But along the way, it's made some incredible moves. It went down to 2003, it went up to 2007, clearly it cracked 2007, 2008, until March the 9th, 2009, engraved on my soul. And from that, apart from the odd little blip, the Euro crisis and COVID, we're still in a bull market now. How long that's going to last, I don't know. So 21 years, unfortunately. So it's easy to ignore market direction. And that is, in fact, my representation or metaphor for a market. They take years to get up and they fall very quickly. So I've got the front page of VectorVest now, and I'm going to go back into the program because it's a little bit bigger, easier to see. So I go back into the program and that's impacts that Gary was speaking about. It's trading on double the VectorVest valuation. The RV is good, RS is good. So and it looks very expensive at 44. So what this is saying, Gary, is that the share price is trading well above the VectorVest valuation. If the share price stays at 10 and the earnings come in as we expect at 26% a year, that in some time over the next 3 years at 10, it's going to be, in fact, significantly undervalued. So what VectorVest is saying now is that the share price has run, in the short term, it's run too far. But over a window of 3 years into the future, it looks good. It's not the same bargain, however, as Sylvania Platinum, which in fact is really cheap and got this huge RV. Okay. So the only red flag on the share at the moment is that it's trading well above the VectorVest valuation. RV is good, RS is good, and by all means you could put it into a worry-free portfolio. And sometimes I would. Susan Thornborough also runs a worry-free portfolio, but she takes a step which is more conservative than I. She does not buy into shares that are trading above the VectorVest valuation. What is the danger in a share that's trading above the VectorVest valuation? Well, I assure you that it's up there for a good reason, in that the market has bought in to the future and are happy to price it in what the share is going to do. And if they don't do it, it gets a haircut very quickly. So there's simply more risk in trading in a share or buying into a share that's trading above the VectorVest valuation. She doesn't want to take that risk. So I hope I've explained that. Very difficult to explain all these nuances in a second. There's a great deal of information here that I could spend hours on. Okay. Character, for example, trading well below the VectorVest valuation and on an RV of 1.48 and it's on a PE of 6. That looks like a bargain, and it is a bargain. RV is 1.48. The only problem with the share is that it's terribly illiquid, but it's an outstanding little company and an outstanding little investment. But it's largely illiquid for any form of trading. So I hope I've explained that as best I can, Gary. So if we go to the home page of VectorVest, the home page of VectorVest is designed to give you a snapshot of what's going on in the market. And at the minute, it doesn't look great because the two most important words on VectorVest are these two: down, up. And this tells us the trends on the overall market. And the overall market is defined by the VectorVest composite, which is a composite index of all 2,200 shares that we follow. It's our own unique measure of the London market. It's an equally weighted index as opposed to a market cap weighted index. The first word is down, the second word is up. The first word represents the short-term trend of the London market, and the second word refers to the underlying or the longer-term trend of the London market. And very importantly for us today, this call refers to the longest measure of the trend on VectorVest, which is a confirmed call. And the confirmed call is simply the underlying trend confirmed by price action. And that confirmed up is a signal that ignores a great deal of the noise, and that confirmed up has been in place since the 11th of November last year. So this is not noisy at all. However, the short-term trend is down. Longer-term trend is up. Because the short-term trend is down, the traffic light, which measures the strength and the momentum of the short-term trend, is pointing into the red, and it's saying that the short-term trend is down and down fairly aggressively, and that we do not advocate buying any stocks at the moment. Now, for our worry-free trading technique, we want to buy stocks when we've got a confirmed up in place, which we have, and this pointer is in the green, and it simply says VectorVest advocates buying safe undervalued stocks at this time. And simply, we want the long-term trend to be up and the short-term trend to be up with conviction. So for the last 2 weeks now, it's been time to sit on our hands and do nothing, watching our stop losses very carefully. Investor Success says, can you use VectorVest to make money in a bear market? By all means, but that's much more aggressive trading. And if you're trading in a bear market, we have got searches to find shares that are falling. By all means, yes, by all means. By all means. I haven't used much of them in the last while because the trends have been very strong. Okay, but by all means you can. So if I go to timing, I can show you how these are actually put together. And that, folks, is the VectorVest composite. Go back to the COVID fall off. And there's the COVID sell-off. And that's the low last March. And this is what the market has done. The trend has been up. But as you can see, over the last 2 weeks, the short-term trend of the London market has been down. So short-term trend is down, longer-term trend is up. I'm hoping that the short-term trend is going to turn soon into the same direction as the long-term trend. But until that happens, it's time to sit and watch stop losses carefully. This little drop down has got all of the VectorVest market timing systems. 1, 2, 3, 4, 5, 6 of them. Systems for long-term traders like we're going to try and talk about today. And short-term traders, for example, if you were shorting the market, invariably that's done by short-term 2 to 3 day trades. You've got to be much better, Investor Success, to short the market than to be long of the market. Nobody believes me about that until they have a go themselves. If I click on confirm calls, we can see the confirm calls marked on the screen. Yes, Louise, the recording will be with you relatively soon. I've gone on a bit long, I know. That was the confirm down in February last year. That was the confirmed up. We had a little bit of a roadblock here. I think the second lockdown scared the market a little bit, and this is where we're at the minute. So longer term trend is up, shorter term trend is down. VectorVest advocating do nothing until the short-term trend changes back into the direction of the long-term trend and the advice improves. So when we've got a confirmed up, we want to be fully invested in 10 to 15 shares that have got an RV of greater than 1.25 with a high RS that are on a buy or a hold recommendation with sufficient liquidity for our portfolio. When we get a confirmed down, we simply do nothing. We certainly don't buy any shares. We watch our stop losses very carefully indeed. In this little confirmed down, we didn't get stopped out of anything. But if we were to get stopped out, we build a cash position. So let's say we get a sell-off, and in that sell-off, 2 shares go below their VectorVest stop loss. We simply get out of those, and that would mean that we're 8 in a portfolio of 10 shares. We've got 80% of our cash in shares, 20% in cash. When we get the next confirmed up, we go back to being fully invested again. Now, sooner or later, we're going to get a red triangle here. Sooner or later, I don't know when it's going to come. Sooner or later, we'll get it. That means certainly no buying any more stocks. Watch your stop losses very carefully. If the general market sells off, we don't know, is it going to be one of these that's going to last a week or two? Or is it going to be something like this? Nobody knows. In this little pullback, I was stopped out of none of my positions. In this one, I was stopped out of everything. Everything. Just there. That's the first time that's happened since 2007, where we were stopped out of everything. So I went into this with cash. Now, if we go back and have a look at 2019, there's the first signal of 2019. That was on the 6th or 7th of January. This bounce around in the UK summer is quite common, where the market just goes into complete doldrums during the summertime. These little pullbacks didn't do anything at all to the portfolio. Apart from this one in August, and we got stopped out of 2 shares in August in this little bit of a pullback. That meant that in this period, we were 80% in shares, 20% in cash. When we got the next confirmed up, we went back to fully invested, and in this little bit, we didn't get stopped out of anything. So in 2019, there were 2 trades. And then we got stopped out of, I got stopped out of certainly, pretty much everything here. So between there and there, I was up 47%, and I gave 15% back here. And from this low, pretty much still in the same stocks, and we're up, I'll show you later, about 50% since that low. Sooner or later, we're going to get another one of these. I don't know, is it going to be a mess like this, or are we going to get a crack? Does anybody know? Of course, I don't think they do. The investor success, the VectorVest stop loss is calculated for us for every share every single day. So if we look at a share like Sylvania Platinum that I talked about, there's the stop loss, 123. So a close below 123, we exit. It's calculated for us every single day. It's based around a moving average, adjusted for the fundamentals. So there's nothing left to chance. Everything is done for you. Okay. So that's the basis of what we're trying to get across, folks. When we get a confirmed up, fully invested. When we get a confirmed down, do nothing. Watch your stops more carefully, because there's a higher probability that you're going to get stopped out of a share if the general market is falling. Most confirmed downs come to nothing, but you've got to be wide awake, because we don't know, is it one of these in front of us? Okay. Gary wants the other columns. Well, that's the code. That's the exchange, AIM or the London market. That's the price of the share. That's the value. This is just how it moved yesterday. RV I've explained. RS I've explained. RT is the short-term trend. And VST is the value, safety and trend all put together. That's buy, sell or hold. That's the VectorVest stop. CI measures the long-term trend. GRT is the percentage annualized growth rate next year, which is a big part of RV. That's earnings yield, PE, growth to PE, and then on the right-hand side, we've got dividends. Dividend yield, dividend safety, dividend growth. That's pretty much it. Yes, it's an end-of-day program, Investor Success. We look one a day. Yes, I do lots of sessions on swing trading. Jason, lots. So let's try and put this all together into a worry-free trading plan. And Jason, you don't have to, many people think that this is too conservative for them. Very few swing traders will make as much money as worry-free traders. Getting out of the way in shares with great fundamentals when the general market is rising and avoiding the day-to-day noise is a great way to build wealth without a great deal of effort. UniSearch does all the hard work for us because we can actually input all of the parameters that we want. Does worry-free mean buy and hold? No, it means manage the risk aggressively. If the share hits its closes below its stop loss, we get out. Simple as that. So it is buy and hold if the share performs. If the share doesn't perform, we get out of it and get into something else. But yes, if the share is performing above its stop loss, we could be holding on to it for years. And the key is buying the right stocks. And the right stocks are those shares that are growing earnings aggressively and safely. And there's very few of them on the London stock market. Now, we've tested this going back for years. And many of us, including myself, have been testing it going forward with real money. And the key is relative safety. We want that relative safety to be well above 1.25, 1.3, as high as possible. And we want earnings to be growing strongly with that RV greater than 1.25. And I've written a very, very simple search here. And the search, I'm looking for a share that's above 50 pence. So I'm going to try and ignore all those little companies that are trading at 2 or 3p. Above 50 pence. I put a volume criteria in there. The 50-day moving average of volume is greater than 50,000 shares. Not a lot, but remember, this is not a trading search. We're hoping that these shares are going to actually move and move for a long time. I've ignored AIM in this, but many of our people put AIM in there and they do very well. So for this, I've ignored. That double R means not. Relative value greater than 1.25 and not on a sell, which means it's either buy or hold. And we use the confirm calls to get in. Those are the confirm calls again. Chart's a week or two out of date. And that's what it did from the confirm call on the 27th of April to the 19th of April. It was up 52%. I'll run it in a second with current data. And from the last call up, the market sold off a little bit. It's up 17% since November. And as you can see, clean sheet. So let's run it now. We've lost, the market's pulled back a little bit since the end of April. So if I go to the program, go to UniSearch, that's the search. It's long-term winners RS descending. It's actually in your retirement folder. Investor Success says, do you recommend trading indices? That's not what this presentation is about, okay? Trading indices, short-term trading of indices is aggressive trading. That's not what we're talking about here today. Okay, so that's today's date, but if I go back to last April, and it's a short way of doing this, as you can see, there's a green mark on the date. That's the confirmed up on the 27th of April last year. Easy to do now, but I assure you that when I bought stocks around the 27th of April last year, I was laughed at because that was the lockdown. The world was going to fall apart, if you remember. And the emails that I got from an awful lot of people when I announced that I was buying stocks were quite interesting, to say the least. That's what comes out. And if I just quick test the top 10 now, quick test is just a simple test between the share price last April and now. And that's what it's done. The market's up 30% and this is up 47%. And the really nice thing is that there's no losers here. Now, along the way, the only share we were stopped out of was Avon Rubber. It was stopped out along the way. For a profit, a good profit, but we were stopped out. It pulled back and hit its stop loss. And most of these I'm still holding. So that man who talked about trading the indices, 75% of all the spread bettors customers go bankrupt. Okay, if you want to trade indices, I know all about trading indices, and my best friend is probably the best index trader in the world, and we worked together for many years. So I know all about that, but that's not what this presentation's about. And if I were trading indices, I would do that to make cash. And with that cash, I would put it into this type of portfolio. It's hands off, let the ball do the work. If you're sick, the worry-free stocks will be making money for you. If you get hit by a bus, it's not the end of the world. Shares that are undervalued, shares that are growing earnings strongly and aggressively. I don't care how many algos are in the world. If you've got a company that's making more money next year than it does this year, that'll sooner or later be reflected in the share price. If we go to November, the confirmed up in November. There we go. And that's the most recent one. And many of the same names here. And we quick test the top 10. It's outperformed the market. That was up at 17 at the end of April, so we've given back a little bit, but it's 25% annualized. And over the last 25 years, this method has made about 15% annualized plus about 4 to 5% dividend yield. So it's had a very, very good run. Very good run indeed. If the general market is rising, Gary, yes. Gary says that a lot of searches are on a hold. If the general market was rising, then yes. You could certainly add to that, Gary, that you only want to take them on a buy, but I've found that certainly from a major low, buying them when they're on a hold is okay. I've tested this over and over again. That was 2019. And this little period here, I was stopped out of 2 stocks in this period, just there. And that's what it did in 2019, 44%. And that's what we were up until COVID hit. And then I gave 15.5% of that back during the COVID thing. Big deal. Jay says, how does CI compare to the confirmed call? Well, CI is applied to every single share. So CI is a function of a single equity or stock, whereas the confirmed call is a measure of the overall market. So if you want to use CI, then you would in fact want to buy a high CI stock when the general market was pointing upwards. So you could put together like that, but just remember CI is a function, is a measurement of an individual stock, whereas the confirm call is a measure of the trend of the overall market. So in essence, we want to buy shares with outstanding fundamentals that are rising in price, and the CI would measure that when the general market is rising, and the confirm call would measure that. So applied to two different instruments. Does that make sense, Jay? The longest test I did on this was over 20 years, and this was done in the US from 96 to 2016. So lots and lots of different market types. Along the way, there was only 177 trades in 20 years. That's a trade every 6 weeks. We started off with $100,000, and out of that $100,000, we got $51,000 worth of dividends, which weren't added into the mix. And that's what it did. Not easy. There's the bear market from 2000 2003. That's the crisis where we were stopped out of everything. And that's the euro crisis. And clearly now it's gone upwards towards heaven here. But that's in the American market, 17% compounded rate of return, plus about a 3% dividend yield. The American stocks don't pay the same yield as ours would pay. In the UK, about 14, plus slightly higher dividend. Yes, there's more stocks in the American market with a high RV and high RS. Yes, there's 10. We cover 8,500 stocks in the American market. So yes, there's more. It doesn't matter what investment technique you're looking at, whether it's short-term swing trading or longer-term investing, there is more opportunity in the American market for any one technique. This is just one technique. Okay. However, at the moment, in terms of value, the UK market is significantly cheaper than the US market. So you might be wondering how you put this all together. Well, I've hopefully got a plan. You can do it yourself. Now, that was me trying to keep the financials under control. I failed completely. So to break out, I put together a little course. Now, those of you that have got VectorVest, I'll show you where to get this in a moment. Those of you that haven't got VectorVest, well, here we are. My little course, I've had it professionally narrated, and the first part of it is all about how to analyze any stock. So immediately you'll be able to tell the stocks that you're holding, the stocks that you're thinking of buying, whether they're good or bad. And module number 2 is all about risk. Remember my little mantra: don't avoid risk, manage it. And this will show you how to weed your portfolio to get rid of the bad ones. How to size your positions. How to actually get out at the right place. Knowing when to sell. Knowing when it's safe to buy in. So the first module is all about sorting out good from a bad. Second module, getting rid of the bad ones. And then the third module, when is it safe to buy in? And then what to buy. Cherry picking checklists, of which one will be the worry-free checklist that we've been talking about today. There's another cherry picking checklist for more momentum type trades. And then how to put together a little plan where you can keep this under control in a few minutes a day. So in the US, they charge a fortune for that, $475, but we're new here. So if you roll up your sleeves, folks, and I don't care whether you've never been near a market before. If you roll up your sleeves, you work with me. That's £5.95 and vectorvest.co.uk/proven. And just remember, we are authorized by the FCA, and I'm not going to put that in danger for your £5.95, I assure you. That's going to include 30 days access to VectorVest. Now that's VectorVest World, which is UK, USA, Canada, the whole of Europe apart from Scandinavia. Maybe Scandinavia in Europe, I don't know, and Australia. So that's the VectorVest World. So that comes with your 30-day trial to VectorVest. Now, after the 30 days, VectorVest is invoiced at £49 a month. It's on a month-by-month basis. And if you don't think that we can show you how to make money with VectorVest or grow your wealth with VectorVest, then you can stop it at any time. But after the 30 days, if it's not for you, you give VectorVest a shout and all will stop. And I've been with VectorVest now for 11 years, never had any problems whatsoever with that. Thank you, Yadi. That's very kind. That's very kind. Yadi says he's just finished his 30-day trial and he's now a fully fledged member, and he strongly recommends it. That's excellent. Thank you. With the 30-day trial, I do Q&A webinars on a Monday afternoon where I review the entire market. My colleague Glenn does webcasts on a Thursday. They're called Trending Thursday. And once a month we have a user group. It's called the Streetwise Investors Club. We're actually meeting tomorrow night again. And we have group meetings that meet around the country. They used to be physical, but certainly for the last 18 months they've been all online. So that's included. And lots of people have done this. This is Tom. He's a farmer from North Somerset. And he's been in the market for 30 years. And for 30 years he's lost money. And now he tells me he's making money for the first time. For 30 years he's been buying the top tick and selling the bottom tick. Hopefully I've got him sorted out. So, and if you don't think it's the best £5.95 you've ever spent, you give me a shout and you can have your fiver back with the greatest of pleasure. So vectorvest.co.uk/proven. Yes, Charles. Well, Charles, if you're a subscriber, I'll show you where to find it. If you go to VectorVest UK, oh dear David, if you go to VectorVest under training, that's the course. Okay, there you are. What you can also do, if you go to the VectorVest Navigation Training Series, it opens a different window. And there are dozens of videos done by Glenn Tompkins, who knows the program back to front, on how, in fact, to actually navigate the pro. So if you have a question on UniSearch, there's 3 videos on UniSearch to get you right. Okay. So Charles, there's the training for you, okay? So folks, I look forward to working with you. vectorvest.co.uk/proven. You can get hold of me anytime. david.paul@vectorvest.com. Okay. So I've kept you far too long, folks. I hope you enjoyed the presentation. It's a method of standing back, buying into the UK's best shares as defined by our 2 metrics, relative value and relative safety, when the general market is rising. When the general market is falling, then no more buying. Watch your stop losses carefully. If you do get stopped out, you build a cash position until you get the next confirmed up, and then you go back to being fully invested again. Couldn't be simpler. Takes a bit of practice. And sometimes the noise can be scary. But much easier way of making money than trying to fight the DAX in the morning on a 5-minute chart. Those of you that don't believe me, just have a go. Okay, folks, I've taken up enough of your time. It's been a great pleasure to be here, honored to be here. If I can help you in any way, david.paul@vectorvest.com, and I look forward to working with you. Bye-bye.